Have you ever wondered what a balance sheet is for? Better yet, how to read it? I'm going to share that with you in about 2 seconds. Hello, this is Dave Scott Peters, creator of the Restaurant Prosperity Formula and a principal at the Largo Group. Look, I get it. What the hell's a balance sheet? We know what a P&L is, don't we? If not, I'm going to share that with you on another video tip. But what is a balance sheet and why do I even need it? Well, a balance sheet shows you stuff and who owns the stuff. Your stuff might be the food that you have on your shelves, the cash you have in the bank, the building you have. Well, who owns the stuff may be your broadline distributor that you are on terms with. It might be the sales tax you've collected, but it's not yours. It may be the SBA loan, right, with the bank that you have the building, but they really own it. So it's stuff and who owns the stuff. Now, critical with the balance sheet is, it's like the scales of justice. It's supposed to balance. You're supposed to have this much in assets and this much in liabilities, and they should equal. That's how we know it's right. Well, another way to put a balance sheet into a really simplified way is to think of it as a Polaroid picture, right? The old timers like me, we grew up with Polaroids. You'd take a picture and out would spit a photo and you'd shake it till it developed. In fact, I was in Best Buy the other day. It looks like they're coming back. With that said, it's a picture in time, the health of your business. It's the stuff you own and who owns the stuff, preferably one of you being the owner of a lot of your stuff. That's basically your profitability. So let's break down how we read a balance sheet. Let's break it into, again, assets and liabilities, stuff, who owns the stuff. Let's talk about the stuff part, right? That's current assets, fixed assets, other assets. What are current assets? Current assets are those assets you're going to use in the next 12 months. That's the cash in the drawer, cash in the bank. It's the food on the shelves. It's anything you're going to use in the next 12 months. Your fixed assets are those assets you use over and over and over again. That might be your furniture, your fixtures, your equipment, anything you use over and over again. And other assets is this other category for things like liquor license or things that don't fit in those other two categories. That's the stuff. Then who owns the stuff starts with current liabilities, long-term liabilities, and there's this thing called owner's equity. So current liabilities are those liabilities you have to pay in the next 12 months, right? Get the picture now. Current assets used in the next 12 months. Current liabilities, what you're going to pay in the next 12 months. So that might be the bill you owe your broadline distributor, maybe your power bill. It's things you owe right away. And then there's this long-term liabilities, which might be the building. Remember that SBA loan, the bank that owns the building? Well, you're making payments, but it's your building. They just own the stuff. Well, all of a sudden we sit there and say, what do I owe the SBA that I pay over and over again? Let me break that down into even simpler terms. You may have your next 12-month payments for your loan in your current liabilities. You have the rest of it, the next 9 years, left in your long-term liabilities. And then the most important thing to me as an operator of a business is owner's equity. That's basically saying you own some of these assets. That's the profitability side of your business. This is what shows you what you made or lost over the years. This is really important to me. Now, what do I do with this? I'm going to tell you there's one calculation that is critical to understanding your balance sheet, and that's called your current ratio. That's where we take our current assets divided by our current liabilities. And that should give us a ratio of at least 1-to-1, meaning $1 of current assets to pay every dollar in current liabilities. But I'm going to tell you, I'd rather have a 1.2 or 1.25 ratio, that I have $1.25 for every dollar I owe in the next 12 months. That's a healthy business. And I can tell you, when you do this calculation, sometimes you're going to find that you're reversed. You might have 90 cents for every dollar you owe, and all of a sudden you know that you have a cash flow problem. Look, if you want to take charge of your business, you truly want to know where your business stands today as far as financial health, make sure you read your balance sheet and you do your current ratio.